Welcome to Your Wealth Hub, latest episode of our podcast, Conquering Your Financial Future. We're here with Phil Allen from My Debt Advisor. Phil, great to see you again.
Yeah, good to see you, Gav.
Great to have you back in the hot seat today. We're going to cover off a range of topics today, primarily focused on the debt market and more importantly, for people who have mortgages, trying to provide an insight in terms of what's actually happening in the marketplace. And Phil, you're in the hot seat, so are you ready to go?
Yeah, definitely, because there's been a lot happening, so it's a good time to have this conversation.
Yeah, I think so. We've certainly been getting an increased volume of calls, people concerned about their debt positions. There's a lot happening, and let's try to unpack that. So I think we should probably talk about the elephant in the room to start with. We've seen the banks change their focus and their philosophy over the past 3 to 6 months, and probably a surprise to a lot of people was they increased their interest rates out of cycle. There was no Reserve Bank increase, and they seem to have kind of sprung this on everyone.
Yeah.
What's the story?
Look, and this is something which people probably need to accept is going to be the new normal. So the problem is in Australia is that we borrow a lot of money from overseas to fund our mortgages, and the problem is that because of interest rates rising in America and places like that, our lenders have to pay more money, a higher interest rate, to get the money to lend on to people.
So it's actually costing the banks more money.
It is, and this is going to continue. So these little rate rises will be passed on to customers sort of every sort of 3 to 6 months is my expectation.
Yeah, right. So we're going to see small increments start to creep through?
Yes. And the thing is, you won't see, the Reserve Bank knows this, so the actual official rate probably won't go up because they know this is going to happen anyway.
Yeah, and they're also juggling, I suppose, at the same time, a large amount of Australians who are geared heavily into property as well, and they're a little bit nervous about what will happen if affordability comes into play there as well.
Yeah, definitely. So while there's a lot of fear and things going on in the papers, this is something which is being very heavily watched because they do want Australians to get their debt under control, but it's in nobody's interest to have a sudden crash, though.
Yeah.
So while as usual, the newspapers and the press will have a field day, bringing up all the panic and fear, it shouldn't be quite that bad.
Okay. So if we look back 6 months ago, or actually probably even a year ago, when we saw interest rates increase for people who were investing only, the home occupiers, principal residences were largely excluded from that, but now they've been drawn into the rate increases as well. So it is a little concerning, and I suppose the question people would be asking, how far, and without looking into the crystal ball, the imaginary crystal ball, how far do you think this will continue?
Well, from that point of view, the news is good in that we've probably seen the vast majority of the changes that we're going to see. And a lot of those changes were driven by them just wanting to make sure that if things get a little bit scary globally again, that our system is very robust. Where really things have been pretty loose. All it now means is that they're paying attention to the detail.
Sure.
So they are actually really looking not just at your income, but they are closely looking at what are your real expenses. But while you may have to get together a few more documents and things, it's generally still no issue getting the money. Just a little bit more work ticking all the boxes.
Yeah, okay. So if we're considering that, most of us will probably be looking for some kind of stability from our banks. And if we think how long it's going to last, well, we've just seen the worst of it now as we've kind of seen the structural reform of how we're obviously seeing interest rates come through. From a stability perspective, what could we be up for in the future, and how can we provide a more stable environment for ourselves? What's your thoughts there?
Well, look, the biggest thing is this is not going to go away. This is not a short-term fad. Most of the changes, when you look at them, are very common sense. But what it means is if you have had your loan for longer than the most recent year, particularly if you've got things like investment properties, is it really makes sense to have a good look at the interest rates you are paying. Are you overpaying? And just taking that chance to understand where you sit in the new lending environment.
Yeah, sure. And that probably begs the question then, given that we're seeing interest rates start to creep up, the old question of variable versus fixed rates, where the majority of the market for a long time have been on variable interest rates. Is it now a time where people should be considering fixing it for a period of time?
Yeah. Look, there's a lot of purists who basically say that you should always leave your loan variable, you shouldn't fix. And and that's because there is a risk that you're paying a bit of a premium when you fix your rate. But if you're in a position where you have, it still has a very valuable purpose, where if you are a little bit tight in your budget, or you do have kids and a lot of expenses, you're going through a period in time where you have a lot of expenses, then while rates are at this very low level, there can be a lot of value in actually just locking that rate in for a few years,
Sure.
with no risk of it changing.
Okay, so good from a management of cash flow and helping people kind of plan out how they're going to manage their daily expenses.
Yeah, absolutely, and particularly if at the moment there really is a fairly strong expectation that these little rate rises are just going to continue to happen over time.
Sure.
So
Give me an example of what the difference would be between a fixed rate currently and a variable rate. What's the differential there?
well, this is where it's actually quite interesting. So at the moment, there are quite a lot of fixed rates out there where you can pretty much actually get the same rate as the variable rate today.
Okay.
Which is interesting when you do expect that the variable rate will rise. And it's very similar for investment as well, but in fact in investment it's even a little bit more out of whack, where because the government has artificially pushed lenders to make investment loans more expensive, it means that the variable rate has been pushed up quite a bit.
Sure.
But it's not connected properly to the fixed rate. So in a lot of cases, we're actually seeing you can get fixed rate offers lower than the variable rate today.
Lower. Okay.
No, it's very unusual. So when people say never fix, that is when the market is very efficient.
Yeah.
But with all this government intervention and stuff, I personally just don't think that that's working the way it should. So there are a lot of reasons why it's worth considering fixing.
Yeah, okay, good food for thought.
The only caveat being, there is never a 100% guarantee you're better off by fixing.
Sure.
But yeah, there's a lot of arguments at the moment saying it's a very good time to be looking at that.
Okay, well let's turn our heads to interest only, which is another form of mortgage. And for a lot of people, I think the figure I saw in recent times was as many as 50% of people took out interest-only loans on their principal residence.
Yes.
So when we break it down, people were basically paying only the bank charges to live in their home, basically relying on the fact that the market was going to increase.
Yeah.
And that's where they're going to create equity for the long term. And with the market, pretty well consistent across Australia, reducing over the past 12 months, the first 12 months since 2012, it's reduced. How does that play out, and what are the banks doing to respond to that?
Well, again, yes, this is very interesting, because going back 2 years ago, before the focus and the changes started to happen, you could pretty much get the same interest rate, whether your loan was interest only or principal interest, meaning paying it down. So a lot of people took the interest only option because it gave you better control of cash flow and all those things. The issue is that when your loan has been interest only for a period of time, it leaves you a much shorter period to then pay the loan off for the remaining loan term. So it gives you, in the end, a much higher repayment when it comes off. The government has now basically pushed all lenders to basically say you can't give your clients another interest-only period without fully reassessing the loan. So that means some people who aren't really thinking about it, their loans are coming off interest only, and then they're really struggling with a much higher repayment.
I saw a stat, it's between 30 and 40% go from interest only to principal and interest.
And the interesting thing is most people have kind of forgotten that that's going to happen until they get the letter the month before. So it is absolutely essential that even whether it's, and the same is actually applying even for people with investment properties or investments, because we're always told make that interest only, it's not effective to pay off the principal.
Sure.
But because now it's almost compulsory that they come off to the principal and interest repayments, suddenly people who've had a $3,000 repayment are finding themselves suddenly with a $7,000 a month repayment. And while they could afford $3,000, $7,000 has a serious impact. So the biggest message at the moment is that if you do have an interest-only loan, make sure you're aware of when it finishes,
Yeah, that's a good point.
and to actually ask your bank when it finishes, what repayment will I be going on to? That way, at least you can plan it and see whether at least you do have the cash flow to handle that, or whether it's going to put you under a lot of stress. So you can at least have a plan about, well, actually, maybe we need to try and sell that beforehand, or how are we going to cope with that?
And previously, just off the top of your head, how long was that period typically for interest only? Was it 3 or 5 years?
Well, typically it was 5 years.
5 years.
But depending on the lender, so and this is the big problem with investments, it used to be very easy. They should just give you another interest only period.
Sure.
So some people may have been on interest only for 10 years or even more.
Wow. Okay.
And this is why suddenly you come off onto a very big principal and interest repayment.
And if they're looking completely at the serviceability of that loan within your requirements, it's going to mean, as you say, it's a big increase to what they're paying.
And the thing to remember is that by law, they don't just look at the equity in the property. So you might have a property that's worth 4 times more than the loan, but that doesn't matter. By law, they have to see that you can have the income to service the loan.
Yeah.
And that's the part which is catching people out.
Yeah, sure.
So it doesn't matter if you've got $20 million worth of property. If you can't service the loan, they won't give it to you.
Yeah, it's going to create some issues. And like from our observations of the marketplace, we've certainly seen that over the next 12 months, we're going to see a large number of people washing out of those interest-only loans, and that's where I think that combined with perhaps some of the incremental interest rates that we see, and that doesn't even take into account if the RBA chooses to increase by 25 basis points as well. If they do that, there's going to be some concern around housing prices, I think, but that's probably more a macro issue in total than debt specifically. But very interesting. So your point there around interest only, it's about having a plan now and speak to somebody, and if it's not your bank, and speak to someone like you to figure out what you can do, what your options are, so don't leave yourself short. Yeah,
absolutely. And it is because a lot of these things can be reset, and it's going back and just talking to your own bank quite often. They're more limited as to what they can offer you. Whereas it's particularly with all the changes that have gone on, actually looking at what are actually the best offers in the market, and using that to reset your loan back to a 30-year loan term can be a much more effective strategy.
That's good. I feel we've covered off really well the change in the landscape and whatnot. One of the questions that we get a lot of, I want to take out my first mortgage, or I want to get a loan, and I've changed roles recently. And we were talking about this just before we came in today. So, for instance, someone goes from being, a manager in a finance firm, whatever the case may be, or and ends up being a unicorn hunter, something completely unrelated and whatnot, irrespective of the role is. What's what type of rigor do the bank make you go through so they're happy with what your role is defined as now?
It's one of the... There's this whole thing, and all these changes revolve around their strict duty of care to not get you in over your... to protect you from yourself from getting
that's been a big focus.
It is.
In the recent Royal Commission.
So the thing when it comes to job it's quite interesting is typically if you change job and you stay in the same industry doing the same sort of thing you've always done, then even if you're on probation, as long as you haven't had a long gap, they're pretty good at just accepting that, well, clearly you should be able, even if it's something happened to that job, you'll be able to get something similar in the market. The big drama happens where you decide to actually have a bit of a career change. And I have seen where people have gone to find out how much they can borrow, what they can do, or they know their loans are coming up and need to be changed soon. And one of them goes and starts a new business or moves into a totally different job. The issue is from the bank's perspective is because you don't have that experience and you're not established, usually at least until you're outside your probation period, if you're employed, or if you've changed to being a consultant or fully self-employed, then often they actually want 2 full tax years.
2 full tax years.
Two full tax years. So if you don't have a history in that industry. So I have often seen people who are close and they're wanting to buy something, and they come back after the first time when we've worked out what they can do. They come back 6 months later and go, oh, we want to renew our approval. By the way, I've done this. And sometimes you just have to tell them,
tough conversation.
Yeah, you're now, and that's actually a very important thing to remember if you do have a loan pre-approval. Even if it's one where they've gone and properly, formally assessed all your information, that approval is based very clearly on your circumstances not materially changing.
Sure.
So I've actually seen some people nearly get themselves in serious trouble where they had a pre-approval, changed jobs, and went and bought a property without mentioning it to the bank or their broker. And luckily in that case they were able to get out of it, but otherwise they would have lost their deposit.
Yeah, absolutely.
So.
Yeah, very interesting. We don't condone hunting unicorns at all. It's not a very good business model, and obviously they're beautiful, graceful animals.
Animal cruelty.
Absolutely.
But probably the other main topic which I would like to quickly bring up though is we've talked about interest-only loans, but one of the big things that people do need to be looking at is also not be afraid to look at whether changing to principal and interest can actually work out as an extremely good option for them.
Actually, that's a good point. We talked about that before as being a great option, obviously, you should be planning for, but is there an opportunity for people to actually move early because they can see what's going to come to help plan effectively?
It is. So one of the things is that, as we talked about, interest-only loans have gotten more expensive, but principal and interest loans have become cheaper to a degree in comparison, and that was partly because the government wanted to make it attractive for people to switch. They wanted to see people starting to pay down their debt. So quite often, even though people have had their loan going on interest only, by changing to the sharpest principal and interest deal, what we're actually seeing in some cases, the repayment's actually almost the same. Because there's such a big interest saving, and instead of just giving that to the bank as interest, it's actually paying down their loan and creating wealth. It's creating equity in their home for them.
Okay, that's a good point.
Yeah, so don't just assume that it's going to cost you a whole lot more. And by taking control of yourself and being proactive, you may change to principal and interest, but you also then resetting your loan to that 30-year loan term, which makes that repayment more manageable.
Okay, well that's an interesting point in itself. We hadn't got into the nitty-gritty about what would happen when you actually transfer across to P&I, and then the difference in interest rate will make, and that's a really good point, actually will subsidise, I suppose, some of the interest payments that would have actually occurred if you can obviously get a much better rate. So look, they're all really, really good points, from what's happening in the marketplace from a bank perspective, why they're changing their lending requirements, why the interest rates are creeping up outside of the RBA's control. Having stability is important, understanding what you can do to manage your own personal situation. Fixed versus variable. Interest only is in some ways a thing of the past now, but it's important if you are switching to make sure you've got a plan, speak to a professional. Changing roles, obviously we're looking at if people are taking out debt, there's a much stronger process that the banks will take you through to make sure you can afford to pay the loan that's in front of you. And the advice at the end there, I really like it. Be aware of what's in front of you when your interest only period finishes. Have a plan, speak to a professional about what's going on, because as always, I dare say, loyalty doesn't get you anywhere when it comes to the banks. So you do have to speak to professionals, Phil, like yourself from Life Debt Advisor. Phil, thank you so much for your time. It's been fantastic. Thanks a lot. Thanks for tuning in to the latest podcast for Conquering Your Financial Future. My name's Gavin Glosier, and we'll see you next time. Thanks a lot.